Hey, if you inherited different types of accounts from a loved one or different assets, it can be confusing, so let's get into it.
Lightning strikes and then you're gonna know my name.
You know, working with clients over the last 35 years, there have been many occasions where they have received an inheritance, and what my job is to do is to help them navigate their options. So the first thing we look at is what type of asset or what type of account are they inheriting, because that makes a difference. Now, in this video, I want to concentrate on inheritance received by a non-spouse. So maybe it was your father, mother, grandparent, or other loved one who left you an inheritance. So really what I'm talking about, anybody except a spouse, because this also makes a difference. Now, many people may think they're going to owe an inheritance tax. So let's get this one out of the way first. There is no federal inheritance tax, and only 6 states, Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania, impose a tax on inherited assets as of 2023. Now, there is a federal estate tax, but that only applies if the estate is worth more than $12.92 million in 2023. So for a lot of folks, that is not going to apply. However, depending on the type of asset or account you inherit, there could be possible income tax you would pay. So let's take a look at different types of accounts and how income tax would be treated. But before we do, if we haven't met before, my name is Keith Wilson, and I am a financial advisor helping people just like you navigate their financial goals. And hey, while you are here, I would really appreciate it if you'd give this video a thumbs up and subscribe to the channel. Okay, the first type of account we are going to look at is an IRA or 401k. With inherited IRAs, you must understand that taxes have never been paid on that account. So if you simply cash it out, you will pay taxes on the whole amount in the form of ordinary income tax. And that is just going to be taxed at whatever tax bracket you are. So what some folks do instead of cashing out is they will open a beneficiary or inherited IRA and have those funds rolled over into it. That way, you do not pay income tax on that transaction. You would only pay tax on amounts that you withdraw. But here's the thing, rules have changed on inherited IRAs. It used to be that you were only required to withdraw what is called a required minimum distribution, or RMD, and that RMD was based on your life expectancy. And theoretically, that account could possibly last your lifetime. And so this was known as the stretch IRA. However, since the Secure Act, the IRS said this. They said, you know what? We're going to do away with the stretch IRA, and now you must liquidate that inherited IRA within 10 years. And at first, it was unclear as to if RMDs would still apply or just, simply have the account liquidated within 10 years. The IRS did waive RMDs for the first couple of years, as well as 2023, but still up in the air going forward. So here's a planning strategy for inherited IRAs. What some people do is withdraw funds from the inherited IRA and put it into a brokerage account. And they'll do this periodically. And since you have to have that IRA liquidated within 10 years, consider this. Consider making larger distributions in a down market year and reinvest in the brokerage account. That way, there would be less in that inherited IRA and potentially save some in taxes. All right, now let's look at inheriting a Roth IRA. Unlike IRAs or 401ks, Roth IRAs are tax-free if that Roth has been opened for 5 years. So you could go ahead and withdraw the whole amount with no taxes or penalties if that account was opened at least 5 years ago. If you open an inherited Roth IRA and have those funds rolled into it, then like the inherited IRA, it would have to be liquidated within 10 years and RMDs would apply. So here's a planning strategy for inherited Roth IRAs. Since they grow tax-free, consider keeping it in the Roth for the 10 years, then move it out to a brokerage account at that time period. So think about it. All that potential growth in those 10 years will be tax-free when withdrawn. And you might want to check this video that I posted that talks more about inherited Roth IRA tips. Another type of account that you may inherit is a brokerage account, something like stocks or mutual funds or bonds or other types of securities. So when you inherit a stock, mutual fund, or bond, then you enjoy what is called step up in basis. What does that mean? All right. For example, let's say your mother passed away and left you a stock. And when she originally purchased the stock, she paid $10,000 for it. This is called her cost basis. But over the years, let's say it has grown to $100,000. So the gain there would be $90,000. The cost basis for you would be what that stock was worth on the date of her death. So if it was worth $100,000 when she passed away and you turned right around and sold it for $100,000, then there would be no tax to you. If, however, you later sold that stock at a gain from that, $100,000 basis, then that would be a capital gain. Anything above that $100,000 in this example. And that capital gain for most people would be at a rate at 10%. So here's a planning strategy. What you could do here is you could have those assets in the brokerage account transferred to your name and have the securities transferred in kind, meaning nothing is sold, it's just now in your name. That way, you can continue the investments with a step up in cost basis. Just make sure that whatever securities are transferred over, that it is aligned with your goals and objectives. Hey, what about real estate? Maybe you inherited a house. How is that treated? Well, just like a brokerage account or stocks, you would enjoy a step up in basis. So whatever the house was worth on the date of death would be your cost basis. If you later sold it, then you would pay capital gains on the gain of the property from date of death. And again, for most people, that is 15%. A planning strategy to consider here is that let's say you don't want to sell it right away, and it may be several years before you do. You have lived in the home for 2 of the last 5 years and then sell, there would be no capital gains tax as long as that profit or that gain is under $500,000. So you can see, depending on the type of asset or account you inherit, makes a difference on how they are taxed. That's why I encourage you to get with your tax advisor before implementing any of these strategies, just to make sure they are in line with your particular situation. Hey, don't forget to subscribe to the channel, and we'll see you next time.
A champion Joe